Hello folks, I am Sarfaraz Khan, and welcome back to another episode on Stock Sage Insights. Today, we are shining the spotlight on a company that has been making waves in the energy sector, despite challenging market conditions. Today, we are going deep into Ranger Energy Services. It trades on the New York Stock Exchange under the ticker symbol RNGR. For those of you who are new to the company, Ranger Energy is a relatively smaller player in the oilfield services sector, with a market cap of $250 million. What makes it stand out is its comprehensive suite of services, including high-specification onshore well service rigs, wireline services, and processing solutions, all tailored for U.S. oil and gas producers. Now, why should you stay glued to this video till the end? It's because we are about to dive deep into the company's financial performance and industry positioning. We'll uncover how this underdog, in a challenging year for rig operations, has managed to significantly ramp up its revenues, earnings, and margins in 2023. We will also shed light on its debt reduction strategy, share buyback plans, and the potential for dividends. Moreover, we'll discuss some exciting reasons as to why Ranger Energy Services might outperform its competitors in the coming times. We'll also decode the company's knack for effective money management, which has helped strengthen its balance sheet substantially. Finally, to help you make an informed decision, we will also be diving into the risks associated with this investment. After all, every investment comes with its share of potential pitfalls. Ranger Energy is no exception, especially as it operates in the ever-unpredictable oil market. So, whether you're considering adding Ranger Energy to your portfolio, or you're just interested in understanding the dynamics of the energy sector, this is one video you don't want to miss. Buckle up, grab your notepad, and let's get started. You might remember that last year was a bit of a high tide for many of these companies. Why, you ask? Well, oil and gas producers were busy deploying rigs, aiming to either sustain or ramp up production. This led to a significant upturn in drilling activity. To give you an idea, Baker Hughes's data shows us that the rig count skyrocketed over 30% in 2022. We started off the year with around 590 rigs, but by the time we were singing "Auld Lang Syne," we had almost 780 rigs. Quite a growth spurt, wouldn't you say? But hold your horses, because 2023 is painting a different picture, something I've touched upon in my previous Seeking Alpha articles. Don't worry, you can find the links in the description below. Rig count, this year, has mostly been on a downhill journey. This downward trend has become more evident since April. Apart from 3 weeks, the last 15 weeks have been a little somber, with a decrease in rig count week after week. Fast forward to the week that ended on July 7th, the rig count was standing at 680 rigs. That's a modest bump of 6 rigs from the previous week, but if we compare it to the same period last year where we had 752 rigs, we can see a considerable drop in drilling activity. This declining trend poses a tough puzzle for oilfield service providers to solve, especially for those operating in the US. Among these is our spotlight company for today, Ranger Energy. Now, Ranger Energy might be a smaller player, with a market cap of $250 million, but it has a wide array of services under its belt. The company provides a range of well completion and production services. This includes high-spec onshore well service rigs, wireline services, and processing solutions, all tailored for U.S. oil and gas producers. These services represent the company's 3 main segments: high-specification rigs, wireline services, and processing solutions and ancillary services. The high-specification rigs, which accounted for almost half of Ranger Energy's revenues last year, are its most substantial segment. This part of the company encompasses a robust fleet of 428 well service rigs, which make well completion, workover, and maintenance services possible. So, while Ranger Energy may be a smaller fish in this big ocean, it's certainly making some notable ripples. Alright, folks, we're diving deeper into Ranger Energy's journey. This year, the tides haven't been as friendly as they were last year. But here's what's impressive. The company not only weathered the storm, but significantly ramped up its revenues, earnings, and margins in 2023. Let's turn back the clock to the first quarter. Ranger Energy reported a growth of 27% in revenues from the same time last year, pushing the total to a whopping $157.5 million. The company's adjusted earnings before interest, taxes, depreciation, and amortization, or EBITDA as we often call it, didn't just increase, it more than doubled to $20.9 million. And that's not all. They managed to broaden their adjusted EBITDA margin by 5 whole percentage points, hitting the 13% mark. But the real zinger? They swung from a net loss of 31 cents per share to a profit of 25 cents per share while also generating a cool $12 million in free cash flows. Talk about a financial comeback. This performance, folks, is no fluke. It's in line with the rhythm they found last year when they saw their revenues multiply, reaching a total of $608.5 million in 2022. Sure, their net income showed a minor uptick from 63 to 65 cents per share, but the adjusted EBITDA? It catapulted from $9.1 million to an impressive $79.5 million, once we leave out those one-time items. And they didn't stop there. They also managed to generate $30.7 million in free cash flows. In the first quarter of 2023, just like last year, Ranger Energy achieved double-digit growth in adjusted earnings across all 3 segments. This feat, along with the enhanced margins and increased free cash flows, is partly due to a surge in rig count and the beneficial after-effects of an acquisition made back in 2021. It also points towards Ranger Energy cashing in on the upswing in prices. But what's truly remarkable about Ranger Energy is their knack for money management. They've used their hefty profits and strong free cash flows to reinforce their financial health. By chipping away at their debt and piling up cash reserves, they've significantly fortified their balance sheet. Time for some numbers. Ranger Energy has done an admirable job in reducing its debt, slashing it from $62.5 million at the end of 2021 to a modest $15.6 million by the end of the first quarter in 2023. Simultaneously, their cash reserves have skyrocketed. From barely anything in the bank at the end of 2021, they've managed to stack up a solid $14.4 million by the end of the first quarter in 2023, primarily thanks to their strong free cash flows. Now that, folks, is financial agility at its best. Despite the dip in drilling activity over the last few months, Ranger Energy Services has shown us that when life gives you lemons, you squeeze out profits. They've managed to ride the wave of demand for their products and services, achieving growth in both earnings and cash flows. So, why do I believe Ranger Energy Services is going to keep up this robust performance and outshine its competitors? Let's look at 5 reasons I have up my sleeve. First up, unlike many oilfield service providers who focus on drilling and completion services, Ranger Energy Services has set its sights on production services. Now, you might be wondering, what's the difference? Well, in a weakened market like we're seeing now, oil and gas producers often cut back on drilling activities by trimming their capital expenditures. But here's the catch: they still need to maintain, repair, and enhance their existing wells. And who do you think they turn to? Yes, you guessed it, Ranger Energy. That's where the company gets a significant chunk of its revenues. Reason number 2, Ranger Energy is flexible. It's nimble, agile, like a financial acrobat. When they saw a downturn in their well services segment in the Haynesville region last quarter, they simply relocated assets to the Permian Basin where demand was robust. And voila, they offset the impact of market weaknesses, maintained utilization rates and price levels, and in turn, safeguarded their earnings and margins. Our third reason, Ranger Energy's business model requires low capital expenditure. Maintaining its fleet of service rigs needs minimal funding, with this year's total capex planned to be a mere $25 to $35 million. And for a company that generated over $70 million in operational cash flow over the last 12 months, that's not much. Consequently, they've been able to convert around 60% of their adjusted EBITDA into free cash flows, which they've used to reduce debt levels. Our fourth point is Ranger Energy's impressive balance sheet. It's like a fortress, and it's only getting stronger as they continue generating free cash flows. Their target is to reduce net debt to zero, a goal they are likely to reach in the coming months. Their adjusted net debt has already plummeted from nearly $80 million at the end of the first quarter of 2022 to just $9.3 million at the end of the first quarter of 2023. If they replicate their performance from the first quarter of this year, when they reported $12 million of free cash flows, they'll hit this target sooner than you can say financial health. Our fifth and final reason is the potential reward for shareholders. With debt reduction in full swing, this opens up opportunities for dividends and buybacks. In fact, the company's board has committed to return 25% of the annual cash flows to shareholders through a mix of buybacks and a 5% per share dividend. The icing on the cake? With the debt reduction target on the horizon, dividends and buybacks are soon to follow. So what's the takeaway here? In my view, Ranger Energy Services has proven its mettle, seizing opportunities in good times and demonstrating resilience in the face of downturns. Their sound financial performance, bolstered balance sheet, and debt reduction strategies should positively impact their valuation and could possibly trigger a re-rating of the stock. Plus, with the upcoming buyback and dividend program, the company's valuation could get a further boost while enhancing shareholder returns. In my book, Ranger Energy Services is a strong consideration for investors. At the moment, the company's shares trade at a forward earnings estimate of just 6.09x, significantly lower than the sector median. This seems quite favorable when compared to industry giants like Schlumberger, Halliburton, and Baker Hughes, which are trading between 10x and 20x forward earnings estimates. The company's shares are also trading lower than its own 5-year average of 16.2x forward earnings multiple. Based on this, I'm rating this stock as a buy. However, like with any investment, there are risks involved. Ranger Energy, like all oilfield service providers, is subject to the unpredictable tides of the oil market. A slump in oil prices could negatively impact the stock's performance. Continued weakness in the oil market could instigate a larger-than-expected downturn in the oilfield services sector. Although Ranger Energy seems better prepared to weather such a storm, it could still face adverse effects on its stock performance. An ongoing decrease in rig count and worsening weakness in the oilfield services industry could create pricing pressure, potentially impacting the company's earnings, margins, and cash flows. This could push its shares lower, a factor investors should take into account before jumping in. And with that, we're nearing the end of our discussion on Ranger Energy Services. Before we sign off, it's crucial to remind you that all the analysis presented in this video represents my opinion and should not be construed as financial advice. If you found my deep dive into Ranger Energy insightful, do hit that like button and subscribe to Stock Sage Insights for more comprehensive market analysis. For those keen on engaging further, join me on Twitter where I continue these fascinating conversations. You can also read my detailed articles on Seeking Alpha for an even more in-depth financial breakdown. If you find my content valuable and wish to support me in bringing more of these insights to you, your backing on Patreon would be highly appreciated. Your support truly fuels my endeavor to provide quality content. Until the next video, keep your investment game strong and make informed decisions. Thank you for tuning in, and I look forward to seeing you again on Stock Sage Insights. Goodbye and happy investing.